Okay, so before we begin, okay, just to remind, stay safe everyone. Okay, avoid going out if kalau tak perlu, if unnecessary. COVID-19 is really crazy right now. Okay, so okay, on chapter 9 last week, okay, we have covered on the GDP calculation. Okay, using 3 approach: income approach, expenditure approach, and also the value added approach. Okay, the main one will be the expenditure approach, okay, followed by the income approach. Okay, the third method, the value added approach, not so, I mean, the focus is basically just on the double counting problem. Okay, so for this topic, we're going to extend on our GDP concept, okay, on the national income. But now we look at how we achieve equilibrium. Okay, the concept of equilibrium we have covered okay, quite a number of times in the microeconomics chapters. Okay, we started on the demand and supply on the consumer side, and we also look at the supplier side on the production, okay, topic, and we also look at the concept on the perfect competition market, the monopoly market, how firm decide how much to produce, okay, what price that they want to charge, okay, for microeconomics topic. Okay, but on the macro side, the concept of equilibrium, okay, when it comes to national income, we want to see how actually we achieve, how do we actually determine when the country achieve equilibrium. Okay, so basically the concept is still the same, similar on the demand and supply. Whenever the two graphs intersect, then you can determine what is the equilibrium output. Okay, so for this topic, I will be using the this slide. Okay, there are 2 slides as well as usual in your OL. Okay, so what we have discussed in the previous chapter, okay, especially when we use the expenditure approach, okay, C plus I plus G plus X minus M. So we have those components as part of the components of GDP. So here we're going to extend on that, okay, and see which one actually is when we talk about national income. Okay, there are 2 concepts that you need to understand. One is the concept of injection, okay, and the other one is the concept of withdrawal. Okay, so injection is money coming in to the economy. Withdrawal is money going out from the economy. Okay, so from the components that we have seen, okay, how to calculate GDP using expenditure approach or even income approach. Okay, when we break down the concept of equilibrium of GDP, okay, so so you need to understand these two new concepts, okay, injections and withdrawal. Okay, so what are the components that is categorized under injections to the economy? Okay, and what are the components that is categorized under withdrawal? Withdrawal is like if you go to the ATM machine and you withdraw your money, so meaning money from your bank account will be reduced. Okay, injection, if you receive money, let's say from scholarship, from PTPTN or any other different sources, so that is money coming into the economy. So in a 2-sector economy, 2-sector means there is no export, there is no import. Okay, so just within the country itself. Okay, so you have consumption, investment, okay, savings, okay, payment for capital. So this is just a brief. And then I think the one which is more complete is what we call a 3-sector economy. Okay, whereby we have the role of government. So government means, okay, there are tax and also subsidy. Okay, and we also have government spending as part of the government role. Okay, so here in this chapter we're going to look in this concept, okay, on the concept of especially on the first we start at the 2-sector economy, followed by the 3-sector. 3-sector means you have the role of government. Okay, and then we want to see how actually from the income that we get, okay, so aggregate income or Y, okay, which is also the term that we use to call GDP. Okay, so here we don't use the concept, we don't use the notation GDP, but we use the notation Y, okay, Y which is income, which is in other words our GDP value. Okay, so we want to know how actually the equilibrium is achieved when we see the interaction between firms and household and also government. Okay, so income, consumption, and saving. So from the consumer or from the household point of view, we as individual, okay, whether as a working people, okay, whether you are working or not. So usually whenever you as a household means person in the, okay, if you an individual, whether in one family or just a single person. If you are not, if you don't have a family, then a household be just one person. Okay, so a household can do only two things with its income: buy goods and services, and or it can save the money. Okay, so when it comes to looking from the perspective of a person, okay, or a household, okay, whenever you receive your money or income from the work that you do, okay, we assume only two things that you will do: whether you spend the money or you save part of the money that you don't spend. Okay, so either, in other words, okay, saving is part, can be treated as the money that you earn minus your consumption. Okay, why we don't put the word equal, but this symbol with a three dash? Okay, because it's not necessarily equal to, but the idea is that in this, when we have this assumption where we treat whatever money that you have only goes to these two components, whether you consume it, okay, you buy goods and services, or you put the money in bank, okay, in terms of as part of the saving. Okay, so saving is derived as income minus consumption. So you need to differentiate between income as a person and income from the country point of view. Okay, because the notation is the same. Okay, why? Okay, so household income Y, okay, in terms of the function, okay, it is positively correlated or positively associated with, I mean, our consumption is positively linked to the income, meaning that the higher the income, the higher will be the consumption. Okay, as income increase, consumption will also increase. I think this is very general idea. So usually, as your income increase, you will tend to spend more lah. Okay, so this is what we call consumption function. Okay, so saving and consumption function shows positive relationship between disposable income and saving. Okay, what is disposable income? We already I think discussed this concept briefly last chapter. Disposable income means income after tax. So let's say if you get 1,000 ringgit from the work that you do, from this 1,000, let's say you need to pay tax up to 100 ringgit. So your disposable income will be 900 ringgit, 1,000 minus 100, meaning income after tax. Okay. So if you look at the relationship between consumption and income, okay, so what determines consumption? Okay, first, I mean, there are three general determinants. Wealth, okay, wealth means your kekayaan lah. Okay, the higher is your wealth, the bigger will be your consumption. And then the price level, okay, price level or the inflation level. Okay, if you feel now, for example, during, I mean, if price level goes up, so for example, if you buy the same, to buy the same quantity of good, you need to spend more lah. So the amount of your consumption will also be related to the price level. The higher the price level or the higher is inflation, okay, you need to spend more. Okay, and that is interest rate. Okay, interest rate is from the bank perspective. So let's say so usually when you talk about consumption, okay, sometimes you need, I mean, why interest rate is part of the determinant of consumption? Because let's say, is it better if you put the money in bank, or you take out the money from the bank and you spend the money? So this is more on the investment perspective, okay, or the return that you get if you put the money in bank, for example, in tabung haji, or in any investment fund like ASB, okay, mutual fund like the public mutual. If the interest or the dividend that you get from keeping your money in the bank is high, then you tend to spend less, meaning you tend to save the money more because you want to get more return, more dividend from your saving. So the higher the interest rate, the lower is your consumption, because you prefer to spend to keep your money in the bank or in the deposit or in the investment account to get more dividend. So that's why interest rate is also part of the determinant of consumption. Okay, and then lastly, expectation of income, meaning what do you expect to receive, let's say, in the future. Okay, if you, let's say now, because of our pandemic season, okay, so many people are out of job. Okay, unfortunately, so some people, whether they are fully employed, I mean, they have a job before, let's say they work in a certain company or factory, or even they are doing own business. Okay, but because of this PKP, MCO, they cannot go out and they cannot open their shop. So you may expect their the income of these affected people will be lower because of COVID-19. So if you expect your income to be less, to drop in the future, so you might want to reduce your consumption now, because you want to save some of your money now to prepare for okay, because you expect if you are going to earn less, to get less money in the future. Okay, so what you will do now is you will tend to spend less lah. Okay, because you want to keep some money for future purpose. Okay, so that is the determinant of consumption. Okay, and then we look at the important part of this chapter. The first will be the consumption function. Okay, so C, which is the consumption, is a function of A plus BY. So what is A? What is B? Okay, Y is the income lah. Okay, household consumption function. Okay, so we already look at this graph. Why this graph is positively is the slope is positive, meaning upward sloping. Okay, means that the higher the income, the higher the consumption. Okay, but now we are going to break down the components in the consumption function. So generally, okay, C of consumption is a function of A. So what is A? A is what we call autonomous consumption. Okay, let me see in the. Okay, so in the next slide, you see this word autonomous. Okay, so what is autonomous? Autonomous means even when your income is zero, you still are going to spend something. Okay, meaning you might use your saving, or you might use money that you borrow from friends or from bank. Okay, so even though you have zero money, okay, zero income, but in order to survive, you still need to spend. So that's why A is what we call autonomous consumption, meaning consumption that does not depend on income. Even though so mathematically, okay, if B is equal to zero, if Y is equal to zero, if this is zero, then C will equal to A lah. So when income equal to zero, consumption is equal to A. So A is what we call autonomous consumption. Okay, or consumption that does not depend on income. So when income is zero, this is the amount of money that you are going to spend, whether you are going to use the money from your saving, okay, from loan, okay, or any other sources. Okay, so that's what is B. Okay, mathematically, B is what we call the slope, okay, the keturunan, the slope of the curve. Okay, so if you draw a simple graph, okay, whether a downward sloping graph or a upward sloping graph, okay, you can calculate what is the slope or the gradient of this diagram. Okay, if you use the basic mathematics function, y equals to mx plus c. Okay? I think you learned this in your secondary school, okay, or in your secondary school. M is the slope of this graph. So how do you calculate the slope of the graph, okay, of a straight line? Okay, change in x divided by change in y. Okay, change in x, okay, divided by change in y. Okay, so that is how you calculate the slope of a simple line graph. Okay. Okay, so if you have this function, okay, and your x-axis is your income, your y-axis is your consumption, so x will be y lah. Okay. Change in y. Okay. Oops, sorry. think I made a mistake there. Okay, not change in X over change in Y. Okay, change in Y over change in X. Okay, so perubahan X bagi dengan perubahan Y. Okay, or change in Y divided by change in X. Okay, so this box here that you cannot see actually is the symbol change. So if you want to add, you want to modify, or you want to put notes, okay, so this symbol actually is the symbol of change. Okay, you might want to, okay, so it will be change in C, okay, divide by change in Y lah, betul lah. Okay, change in okay, change in the consumption divided by the change in income, okay, will give you the value of B. Okay, so B, which is the slope of the consumption function, but we don't call it just the slope. Okay, in economics we call this slope as MPC, marginal propensity to consume. Okay, so the value of the slope will be between 0 to 1. Okay, so this is in terms of the theory. So why do we call the slope MPC? Okay, so basically, okay, if in terms of mathematics, if you divide, if you want to obtain the value of B, B means change in C divided by change in Y. Okay, so you can define it as $1 increase. How much do you increase your consumption, or how much is the change in consumption given a $1 change in income? So if your income increased by $1 or RM1, okay, by $1, okay, how much is the increase in your consumption? So that is what MPC is all about. Okay? Marginal propensity to consume. So basically, this is just the term that we give to the slope of the consumption function. So if your income increased by $1, how much is that $1 is spent on consumption? Okay, so that is what. So let's say B, the value is 0.2. Okay, so let's say the value of B is 0.2. So what does this mean? If your income increased by $1, okay, your consumption will increase by 20 cents. Okay, so that is what B means. Okay, so we can investigate this, learn this issue in the next slide. Okay, so let's say you have a consumption function equals to 100 plus 0.75y. Okay, 100 just now we recall is what we call autonomous consumption. So even though income is 0, consumption is equals to 100. Okay, but then given that the slope of this consumption function is 0.75. Okay, so how do you interpret that? Okay, for every 100 change in income, consumption will increase by 75. It's the same thing. If you multiply by 100, then you say 100 for every 100 increase by 75. But if you put in terms of $1 or one here is in terms of billion. Okay, because we are measuring as the national income, meaning for the whole country. So for every 1 billion increase in income, okay, consumption will increase by 0.75 billion. It's the same thing. Okay, if you want to multiply by 100, then it becomes 75. If you do not want, you want to use the original value, so you just say for every 1 billion increase in income, consumption will increase by 0.75 billion. Okay, so that is what MPC, okay, marginal propensity to consume. Okay, it just it measures the slope of your consumption function, and the way to interpret is you can get from this point here. Okay, so that is on MPC. Okay, so earlier we already discussed. Okay, saving is basically income minus consumption. Okay, so you can also derive the okay, if you look at this part here, B will be equals to the value will be from 0 to 1, meaning the value of MPC will be equals to will be around 0 to 1. Okay? And we also know that whatever money that you don't spend, you are going to save. So that is what this function is about. Okay, so you can see here, if just a simple diagram, if your money, if the income is 1,000, from this 1,000 you spend 850, meaning the remaining will be saved lah. Okay, so because we assume that whatever money that you earn, either you spend or you save it. Okay, so you can also construct what we call as the saving function. Here, this is your income, your consumption function. Okay, and here from this you can construct what we call the saving function. Okay, saving, which is equal to equivalent to y minus c, income minus consumption. Okay, here you can see this what we call the 45-degree line. Okay, so in any macroeconomic textbook, whenever you want to draw, whenever you plot the consumption function, okay, you can also plot what we call this 45-degree line. So what does this 45-degree line means? Okay, so the blue line is your consumption function. Okay, but when you draw a 45-degree line that starts from the origin, when the graph actually, when the two curves intersect. Okay, so for example, between you can see at this point, okay, when the 45-degree line intersect with the consumption function, this value, okay, 400, okay, is what we call the okay, you can see here, okay, why 400? Okay, because when income is equals to 400, consumption equals to 400, okay, saving will be 0. You can see here. Okay, so basically when okay, you can only, so when income is equal to 400, okay, consumption equals to 400, but saving must be equal to 0, meaning when the 45-degree lines intersect with the consumption function, this point is when saving is equals to 0. This is what it means lah. Okay, so and you can see that the gap, if the gap is positive, for example, between if you look at this mathematically, the gap between the consumption function and the 45-degree line is 100, 800 minus 700. So you can see here when at the income of 800 billion, okay, here when income is 800 billion, saving is 100 billion. So how we do that? How we do know that? We can just see from this difference in terms of the value of the consumption and also the point of the 45-degree line. So basically, the 45-degree line can be used to extract the information about your to derive your saving function. Okay, so okay, originally you only have the consumption function, but when you draw the 45-degree line, okay, whenever the gap is positive, okay, anywhere around when the 45-degree line is above the consumption function, this is when saving, you have positive saving, meaning you have money in the bank lah. Okay, but when consumption is above 45-degree line, you can see here, this is the part where saving is negative. Okay, when does saving become negative? When you need to make loan, okay, when you need to borrow money from the bank, you borrow money from Alok, you borrow money from your friend, from your family members. Okay, so this is when you have negative saving. Okay, but if your money in the bank is positive, meaning from your own saving, from your own income, not from borrowing, so that is shown when the 45-degree line is above the consumption function. Okay, so the main thing that you have learned up to this point is first the consumption function, and you have the general function will be A plus BY. A is the autonomous consumption, B is the MPC, marginal propensity to consume. Okay, so and then we also look at how you can derive the saving function from the consumption function, provided that you draw this 45-degree line. Okay, so this is just in terms of the definition. Okay, consumption function shows the relationship between consumption and disposable income. Okay, and also the same goes with saving. Okay, so we have looked at this. Okay, so basically this slide here, okay, the top graph and also the bottom graph is what you saw this one here. Okay, it's basically the same thing. So you can see that this line equal to 0. Okay, So anything below 0 is negative saving, meaning you borrow money from bank. Okay. Anything above 0 is positive, meaning you have money in the bank lah. So to make things simple, we look at this slide here. Okay. So MPC is the change in income divided by change in DI. What is DI? Disposable income, meaning income after tax. Okay. So sometimes you can use DI, or sometimes you can just put Y. Okay. Basically, it's the same thing, but make sure that when you put Y, okay, indirectly you are looking at DI. Okay, meaning that the Y must be disposable income, income after tax. So when you put change in C divided by change in Y, that Y must be equal to disposable income. Okay, so this is the consumption function, and basically it's just like the saving function should be parallel, meaning that the slope, I mean the shape of the graph should be something similar. Okay, sorry, it's not parallel. Okay, because the slope of consumption function, okay, and the slope of the saving function cannot be equal. If it is not equal, then the graph cannot have the same shape. Okay, so actually we need actually to change the slope of the. Okay, I think let me make this one much more. Let's say like this, steeper. Okay, this one lebih landai, flatter. Okay. Okay, what my point that I want to bring here actually is related to this slide. Okay, because we know that, okay, first, what is MPC just now? MPC is the slope of the consumption function. Okay, correct? So we learned that from here. Okay, the slope of the consumption function is what we call MPC, marginal propensity to consume. And MPC must be between 0 to 1. But we also know that whatever money that you earn, either you spend or you save it. So the value of MPS is basically the complement of MPC. Okay, what it means is that if you know what is MPC, then 1 minus that will be MPS. Okay, if you look at this, the previous example just now, okay, if MPC, let's say, is 0.75, meaning that MPS will be 0.25. Okay, in other words, MPS plus MPC must be equals to 1. Okay, so MPC, marginal propensity to consume, plus MPS, marginal propensity to save, okay, always equals to 1. So what is MPC? Is the slope of the consumption function. What is MPS? It measures the slope of the saving function. Okay, so which one is the saving function? The one on the bottom here. Okay? You can construct your saving function from the consumption function. Okay, so basically, if you know MPC, you know what is MPS. Or if you know MPS, you can calculate MPC. Okay, why this is important? Because later on, okay, especially when you look at some of the questions from past years or from the exercises, okay, in the test bank and okay, from any book, okay, you need to use either MPC or MPS to determine what is the value of the national income or the GDP. Okay, because if you are given MPC, you can calculate MPS, and vice versa, because the sum of these two must always be equals to 1. So if you know MPS, 1 minus MPS is equal to MPC. Or if you know MPC, 1 minus MPC is equals to MPS. Okay, so that is the second part that you need to understand, okay, when it comes to the topic of consumption function. Okay, so this is what I mentioned just now. Okay, MPC plus MPS must be equals to 1. Okay, so this is MPC 0.95 means for every 100 increase in income, consumption will increase by 95 and saving will increase by 5. So how do we know that saving will increase by 5? Because if MPC is 0.95, that means MPS is 0.05. So if MPC is 0.95, so MPS will be equals to 0.05. So for every $1 increase in income, saving will increase by 5 cents. So if you multiply by 100, for every $100 increase in income, saving will increase by 5 ringgit. Okay. So this is just things for you to think. What if MPC is equal to 6? What does it mean? For every 100 ringgit increase in income, how much will be saved? How much will be spent? Okay, so this is just a simple application of the concept of MPC and also MPS. Okay, so that is one thing. Next is what we call investment. Okay, or the specific term is planned investment. Okay, so what is investment? Okay, I think we already looked at this concept in the previous chapter. Okay, building expenditure on buildings, equipments, machines, robots, okay, whatever that we call them, they can be part of the capital, okay, capital stock. Okay, so so planned investment, okay, change in inventory is equals to production minus sales. Okay, but I do not want to focus too much on this. Okay, because I think most of the questions or things that you may be tested, okay, okay, just know what is desired, what is planned investment, what is actual investment. Okay, so but what I want to highlight is the shape or the what we call the investment function. Okay, because investment is something that happens in the long run. Okay, you cannot expect, if you want to build a building, it might take years, okay, for the building actually to from the planning to and then from the construction itself, it is something that takes a long time to finish, okay, or to complete. So that's why we assume that investment is constant. Okay? Whenever you have investment, the value will not change, okay, easily. So meaning that that's why the whenever you draw investment function, okay, or plan investment, okay, the value will be constant. It's what we call autonomous. When a variable such as investment is assumed not to depend on the economy, meaning no matter how much is the GDP, okay, how much is the income, investment will remain the same. It's what we call autonomous, meaning the value remain constant regardless of the value of investment. Okay, so investment function I is equal to what we call autonomous investment. Okay, why autonomous? Because it is constant. Okay, the value does not change over time. So because investment is fixed value, the value is a constant, it does not change. So if you recall, earlier in our slide, we mentioned about this two-sector economy. We have investment, we have consumption, and we have saving. So this slide here, okay, basically is about the two-sector economy because we have not touched on the government role yet. So what this graph means, okay, if you recall from the expenditure approach in the previous chapter, okay, how do you calculate GDP? C plus I plus G plus X minus M. Okay, C I G plus X minus M. This is the component of GDP using expenditure approach. C plus I plus G plus export minus import. Okay, so here if you only consider this, let's say we don't have government and we don't have export and import. We only have consumption and also investment. So if you add investment, a constant value, into the what we call aggregate expenditure function. So how do we get aggregate expenditure? Okay, and first, what is AE? AE is the amount economy plans to spend in a given period. So that is AE. So how do you construct AE? AE is C plus I, consumption, plus investment. Because we already know what is consumption function. So if you add a constant into, or if you add investment into consumption function, because we know that investment is a constant. So when you add constant into a consumption function, basically you just shift the graph upward, okay, parallel upward, and the difference between the old graph, the consumption function, and the aggregate expenditure function is this difference is just the value of the investment. Okay, if you recall just now, this is your consumption function. C equals to A plus BY. Okay, A is what we call autonomous consumption, consumption that does not depend on income level. 0.75 is what we call MPC, marginal propensity to consume. Okay, every $1 increase in income, you are going to spend 75 cents on consumption. Okay, but what is AE? AE is basically consumption plus investment in a two-sector economy when there is no government role. Okay, to obtain aggregate expenditure, which is the amount the economy plan to spend. Okay, so how do you get AE? You must add both of the function, consumption function, add with the investment function. But because investment is a constant value, so when you add that, okay, this green line, which is your AE, okay, aggregate expenditure, okay, so you just shift the graph upward, okay, by the value of the investment. I think this is simple and straightforward application of linear graph. Okay, so 100 jump to 125. Okay, the difference is just the amount of the investment. Okay, so so that is AE. Okay, in a two-sector economy. Okay, so next is how do you achieve equilibrium? Okay, equilibrium occurs when there is no tendency to change. So that is what equilibrium. I mean, this is nothing to do on the concept of GDP. Whenever you mention what is equilibrium, what is demand and supply equilibrium, okay, what is market equilibrium? So if you recall from your chapter number 2 or 3, okay, in the microeconomics, when demand and supply intersect, or when demand is equal to supply, you are going to get the equilibrium price and also the equilibrium quantity. So what does this mean? When you achieve equilibrium, there is no tendency to change. It will remain at this point unless there is a surplus in demand increase, okay, or supply increase or decrease due to factors, okay, for example, musim, okay, season, for example, now because of PKP, okay, supply will fall because people cannot go to work. So those are the things that can cause equilibrium to change. But whenever you achieve equilibrium, there is no tendency to change. So this is just a general concept on equilibrium. So in a two-sector economy, why I mentioned two-sector? Because later on, okay, I think we will discuss this in next Thursday lecture. Okay, when you involve government, okay, because later on, okay, when you involve the role of government, okay, on tax and government expenditure, so that is when you are going to look at the three-sector economy. Okay, so that one we will cover on next Thursday lecture. Okay. Okay. So first, when we talk about the concept of equilibrium just now, there is no tendency to change. Okay. So in a macroeconomic market, okay. So just now I mentioned about micro demand and supply, but in macroeconomics, okay, equilibrium occurs when planned AE is equal to aggregate output. Okay, we mentioned just now what is aggregate expenditure is when consumption is equal plus investment. That is aggregate expenditure, what you plan to spend. Okay, so so how do we achieve equilibrium? Is when planned expenditure is equal to aggregate output, meaning that expenditure is equal to output. That is when equilibrium occurs. Okay, so when income or when output is equal to aggregate expenditure, this is when we achieve equilibrium. Okay, so or when Y is equal to C plus I, income equals to consumption plus investment. Okay, so this is when we achieve this, we achieve equilibrium. But when Y is more or Y is less than C plus I, this is when we are at this equilibrium, meaning we are not at equilibrium. So equilibrium only occurs when income is equal to aggregate expenditure. Okay, C plus I is what we call AE. Okay, so you need to understand this few concepts or few acronyms at this stage. Okay, what is aggregate expenditure? What is consumption? What is investment? What is autonomous consumption? What is marginal propensity to consume? What is marginal propensity to save? So these are the concepts that I think you are only learning in this chapter. Okay, we have not introduced this concept before. Okay, so again, how do you achieve, how do you show equilibrium in in a simple diagram? Okay. First, of course, you need to have your AE, aggregate expenditure line. Okay, remember, AE is equal to C plus I. So why do we use AE? Okay, that's why in the very beginning of this chapter, we started by only looking at consumption. We look at consumption function first. Okay, from consumption function, when you add investment, when you add investment together with consumption, that is what we call as aggregate expenditure. This one. Okay. So originally we learned only consumption function, but then when you add investment plus consumption, C plus I is what we call AE, aggregate expenditure. So in this simple diagram here, AE equal to C plus I. So is shown with the green line here. So 1 to 5. So we use the same number as the previous slide. Okay, 1 to 5 because originally, if you recall, autonomous consumption is 100. Investment is 25. So 100 plus 25, you get 1 to 5 here. Okay. So the green line is the AE line. And when you draw the 45-degree line, okay, when you draw the 45-degree line, this is when the two lines intersect, okay? At this point here, this is the point of equilibrium, okay? So at this, when the two lines intersect, when the 45-degree line intersect with the aggregate expenditure line, this point is what we call the equilibrium point, okay? Whereby y equals to c plus I. So what is the value? So you just refer to the point on the horizontal axis, okay? Because the y and the x axis is your income value, okay? Your x axis is your income, your y axis is your aggregate expenditure c plus I. Okay, so when the two lines intersect, the value that you refer on the bottom here is the aggregate, is the equilibrium point. Okay, where so meaning that this value 500 will also be equal to 500 because when you are at equilibrium, okay, equilibrium when achieved when aggregate expenditure AE is equals to Y, correct? So when aggregate expenditure is equals to income, this is when you achieve equilibrium. So that's why at this point, 500 must equal to 500 lah. So the value on the y-axis should be the same as the value on the x-axis. So this is the how you illustrate equilibrium, okay, under a two-sector economy. Two-sector means there is no government role, just investment and consumption. Okay, so the same goes in the previous slide. When the 45-degree line is above the consumption function, okay, so this, whenever you are at this range, you are going to have some saving, okay. Unplanned rise in inventory, output falls. Okay, so this is something similar to what we learned before. Okay, the area here is when your output is less than consumption. Okay, here is when output is more than the aggregate expenditure. Okay, so whenever you are at here, because we are talking about equilibrium. Okay, so if you recall what you learned in the microeconomic chapter, okay, let's say we draw a simple demand and supply diagram. Okay, so you remember the concept of surplus and also shortage. Okay, surplus is when supply is more than demand, correct? At this point, any point above the market price, okay, so this is the market price, anywhere above, we are what we call this part as surplus, mean supply is more than demand, okay, and when supply is more than demand, price will tend to go down because in order to eliminate the excess supply, price need to fall down, and vice versa lah. If you are below here, what we call shortage means demand is more than supply. So when demand is more than supply, price tends to go up in order to eliminate the shortages. The same concept applies here because we are talking about equilibrium. That's why what you see here, unplanned rise in output, output rise in inventory, output falls. Meaning when you are at this any point above or below is what we call disequilibrium. Okay, So if you are at this stage here, okay, meaning that output is bigger than consumption, so so output tend to fall down, to drop in order to achieve equilibrium. Okay, but when consumption is bigger, aggregate expenditure is more than output, so output tend to increase in order to eliminate the disequilibrium just now. So anything above or below, it will go back to the equilibrium point. Okay, so this is similar concept to your demand and supply. So this can be illustrated here lah. Okay, so if you illustrate from C plus I, okay, you have your aggregate consumption plus your investment. So let's say 175 plus 25, you get your AE equals to 200, correct? So when AE is 200, but income is only 100, means that you have negative 100, okay? Because AE is more than Y. So you are not at equilibrium, okay? So negative 100, negative 75, negative 25, these three lines, these three columns here, it is something that you see here in this range. Okay, so so what you see the negative value. So this is the part where AE is more than output. Okay, so it can be shown here. So in this simple diagram, when AE is more than output, okay, all of these negative values, okay, can be shown in this slide, in this part here. Okay, but when output is more than AE, okay, this positive part here, the excess of output compared to AE, okay, so this can be shown in this region here, this part. Okay, and finally, when you are at equilibrium, output is equal to AE, okay, Y is equal to aggregate expenditure. There is no surplus, there is no shortage, okay, there is no disequilibrium, so we achieve equilibrium here lah. So this point is what you see, this point here, the one in the middle. Okay, so I think so we have 20. Okay, so I'll keep the remaining of the slides on next Thursday. Okay, so if before we end, okay, I just want to give you a quick glance what you will learn later. Okay, so basically this one is a bit of mathematics. Okay, because at the end of the day, you will be tested not just on where is the disequilibrium, okay, but mostly on the calculation part. Okay, so one thing that you need to be aware, okay, is this chapter requires you to do some simple calculation. The calculation is not difficult, but choosing the right formula, okay, to understand the concept of MPC, MPS, how to get equilibrium, okay, what is AE, okay, how to use AE in order to find equilibrium. So these are the things that we will discuss in the next lecture. Okay, so I think that's it for today.